For decades, there's been this one really powerful idea from a Nobel laureate that has totally shaped how millions of us invest. It's a simple, elegant piece of math that basically says trying to beat the market is a loser's game. But what if that simple arithmetic has a fatal flaw? Today, we're going to dig into a powerful counterargument that might just change how you think about active investing forever. Okay, so here's our game plan. We're going to start by unpacking this whole zero-sum game myth that's been running the show in finance. Then, we'll start to find the cracks in that famous theory. After that, we'll see why the market isn't static at all, and we'll even retell a classic investing story to see how value is really created. And finally, it'll all come together in a new, much more complete picture of the market. All right, first up, let's get our heads around this idea that has pretty much been investment gospel for almost 50 years. The belief that active management, when you look at it as a whole group, is basically doomed to fail. Yeah, this is the big question, right? Nobel laureate William Sharpe put forward a theory that was so convincing, so airtight that his answer, which was a huge yes, has influenced everybody from regular investors to financial advisors and even legends in the world of finance. His argument is just beautiful in its simplicity. Just imagine the entire market is split down the middle between active traders and passive indexers. Now, before you even think about costs, together they are the market, right? So their combined return has to equal the market's return. But, and this is the kicker, active managers have higher costs. We're talking fees, commissions, research, the whole shebang. So once you subtract those costs, the average active investor must underperform the average passive investor. It's just simple arithmetic. And this idea? Man, it was so powerful, it was championed by investing giants like Warren Buffett himself. He even came up with his own little story, the parable of the Gotrocks family, to explain to everyone why all that frantic trading just makes the managers rich, while the investors get left behind. This image really helps you see why the passive portfolio is that perfect average. The index basically just reflects the collective bets of all active investors combined. Think about it. For every manager who is super bullish on a stock and owns a lot of it, there has to be another manager who's bearish and owns less of it. All those active bets just cancel each other out, and what you're left with is the market average, which is exactly what a passive fund is designed to track. Okay, so the logic feels pretty solid, right? So why, after all these years and all this evidence, is there still a multi-trillion-dollar active management industry? It's not just existing, it's thriving. If the math is so simple and so damning, something's got to be missing from the equation. And that right there, that's the core paradox. Sharpe's theory describes a world that just isn't stable. If it were 100% true, every rational investor would have fled active management by now, and the whole industry would have just vanished. But it hasn't, and that suggests that the theory, as elegant as it is, just doesn't capture the full picture of how markets actually work. So, just to recap, Sharpe's whole argument really boils down to 2 points that seem absolutely impossible to argue with. First, before costs, active and passive investors in total hold the same stuff, so they get the same return. Second, after costs, the active group has to have a lower return. It feels like a mathematical certainty. Sharpe himself, he was so sure about this. He famously said that if any real-world data seemed to prove him wrong, well then, the data itself, or the way it was measured, had to be flawed. That's some serious confidence right there. But the key to taking this entire beautiful argument apart, it's hidden in plain sight. It's in a single, super easy to miss spot in his original paper. Footnote 3. It's where Sharpe basically waves away corporate actions. Things like companies issuing new stock or buying back their own shares, calling them a minor detail. Well, it turns out that footnote isn't a detail. It's everything. And this brings us to the work of Lasse Hage Pedersen. He's the one who pointed out that Sharpe's elegant math is built on this huge, unstated assumption that the market is a fixed pie, and all investors are doing is just swapping slices with each other. But the real market, it's anything but fixed. See, the original theory makes perfect sense in a world that doesn't really exist. A world where no new companies are ever created, no old ones ever fail, and companies just don't mess with their number of shares. But that's not our world. The real world is dynamic. It's constantly changing. Just how dynamic are we talking? Well, think about this. The actual makeup of U.S.-listed stocks has an average annual turnover of 7.6%. And that's not a new thing. That number holds true going all the way back to 1926. Companies are constantly being born and dying. This is the motion that the original model completely misses. This chart is fascinating. It shows you exactly what would happen if a passive investor bought the market at one point in time and then did, well, absolutely nothing. No trading whatsoever. You can see their portfolio would almost immediately start to drift away from the actual market index. And what this proves is that even so-called passive investors are forced to trade just to keep up with how the market changes. Okay, so with this new dynamic view of the market, we can actually go back and retell that classic story from Warren Buffett. So let's revisit his Got Rocks family parable, but this time let's see how an active manager can actually create real, tangible value. So, in this new telling, our hero, Mr. Buffett, hires an active manager. And here's the crucial difference. This manager doesn't just play a zero-sum game, swapping stocks with his passive family members. No, he engages directly with the actual businesses out there in the economy. And here's where the magic happens. Here's how value is actually created. The manager spots a company that's wasting its resources and decides to sell shares back to them during a buyback. He then takes that cash and invests it in a promising new company that's issuing new shares to fund its growth. You see, this isn't just shuffling paper around. This is reallocating actual capital in the real world, moving it from bad ideas to good ones. Now, think about what happens next. Because of the manager's actions, the market index itself has changed. It's now weighted a little less towards the wasteful company and a little more towards the promising one. So what do the passive relatives have to do? They have to trade just to catch up and rebalance their own portfolios. And who do you think is on the other side of that trade, ready to provide the shares they now need? You guessed it, Mr. Buffett's manager, who profits from having made the smart move first. So you see, in this version of the story, active management is clearly not a zero-sum game, not at all. It created real economic value in two big ways. First, it literally made the whole economic pie bigger by helping to direct capital more efficiently. And second, it provided liquidity, smoothing things out by matching people who needed to sell with people who wanted to buy. And all of this leads us to a much more satisfying, much more stable model of the market, one that actually explains how active and passive investing can both exist at the same time, and it solves that initial paradox of why active management is still around. Peterson has this great name for it, efficiently inefficient. I love that term. It describes a market that is just messy enough for skilled active managers to find opportunities and earn enough to cover their costs and make a profit. But it's also efficient enough that those profits aren't so huge that they attract a flood of new competition. It's a kind of equilibrium, a balance. This quote from Peterson just perfectly nails the entire paradox. If markets were perfectly efficient, there'd be no reason to do active investing. But, and here's the catch, you need active investors out there doing the hard work, doing the research, analyzing companies, and allocating capital to create that efficiency to begin with. They're the engine that makes the whole thing work. This leads to one final kind of mind-bending conclusion. We know investors pay billions in fees to active managers. Logically, that means one of two things has to be true. Either the stock market is inefficient, which allows skilled managers to earn their fees, or the market for asset management itself is inefficient because investors are all collectively paying for nothing. It is logically impossible for both of those markets to be perfectly efficient. So this brings us to a whole new perspective. Active management isn't some pointless zero-sum game. It actually serves a vital economic function. It makes our markets more efficient by pushing capital towards its best possible use. The real debate then probably shouldn't be about if active managers create value. The question we should be asking is, what's the right price to pay for that essential service?